Hello, and welcome back to another episode of the Collective Place podcast. This is your host, Brandon Bateman, and today I'm joined by Parker Stiles. Parker and I talk all about portfolio management and some of the things that he's doing to improve his return on investment that he's getting from his real estate properties. Super interesting. I'll see you there. Parker, welcome to the podcast. How you doing?
Doing good. How about yourself?
Fantastic. Thank you. For anybody who doesn't know who you are, what's the short story?
Short story, I've been doing this about a decade. I am a hard money lender. I'm a real estate wholesaler, rehabber. We do hotels, novations, buy and holds, kind of all the exit strategies there. So I have an acquisitions company, a lending company. I do have a coaching company and a portfolio that we're essentially focusing on those first three pillars to build cash. And then we roll that cash into our portfolio for long-term assets and wealth building.
First question, how do you feel about those different things, right? 'Cause I see two sides of it. One side is that's a lot to manage, right? You basically just talked about what's essentially four different companies. The other side is that it's like this hub and spoke model where everything's so interrelated and
Yeah.
they all help each other too. Like, what's your advice for somebody who's doing maybe one of those things? I know you probably just won't say that you regret doing all four of them, but like, what are some things that you thought about when choosing to have all these different companies? And do you think that's a good move for other people too?
I think it's really market driven. It made a lot more sense 2, 3 years ago than it does today necessarily. And I say that just because it's harder right now. There's less transactional volume to be able to work with. It takes more squeeze to get the same amount of juice as it did years ago in the certain market that we're in right now. But at the same time, I bolted those things on slowly with time. And they are very interrelated and they do benefit each other. For example, I would get buyers buying my wholesale deals asking me if I wanted to fund their transaction. And then they would go find another deal from another wholesaler and say, hey, will you fund this one too? The last one was a good experience with you. And we would start to snowball our book of business that way. And so then we started using our private money lenders to fund loans and lines of credit to fund loans. And then we've built warehouse line, facility line relationships with banks to fund a portion of those loans. And that's how that's grown. And then as far as the coaching, I get asked all the time hey, how do we've done 100 deals a year, plus or minus for the last 4 years in a row. And we've got systems and people. And while it's not easy, we have a proven blueprint on how it should be done. And I get asked a lot on, hey, can you give me a masterclass on novations? Or, hey, can we go get coffee? Or can I take you to dinner? And like all of these one-off things were just I didn't have enough time to like really deliver the value that I wanted to give, and B, it wasn't compensating me for what my time was worth. So I needed to create a business, a system, right, around how do I go provide the value that somebody needs to actually do something with that advice, the backup, the support, the blueprint, the documents, the calculators, the SOPs, the hiring out,
Mhm.
all the stuff. And so I spent the last few years putting that stuff in a box and coupling it with one-on-one support. And that's where the Private Wealth Academy came from. By no means is it my sole focus or more of my time is going into my active businesses, but it is a good return on time spent. And it's cool to see other people succeed from a plan that you gave them, because at the end of the day, that's where I got my plan from. I paid for coaching when I got started, and this is a way to make money and return the favor at the same time. And I learned from my coaching students too. It's not like I'm only teaching. Being out there and coaching is another way of learning. And sometimes you come up or get ideas from others that I haven't had myself. So it's a cool kind of full circle experience. And then obviously, if you're just flipping and taking cash, I think you're going the wrong direction. I think you need to be taking cash and investing into long-term assets, creating passive income. When I got started 10 years ago, the only reason I got into flipping houses was to buy rentals. Is flip a few, hold one, flip a few, hold one. Didn't always work out exactly like that. And when you build a business with people and overhead and all that, sometimes you have to flip your way through the month just to make payroll and afford marketing for the next month. But you have to keep a keen eye on your investment strategy. whether that's rentals, multifamily, single family. We've syndication deals with other people, partnerships with other people. We've got some oil and gas mineral rights deals with people we've met along the way and diversified our stocks, whatever it is. For dividends, you need to be putting something that's going to hold the test of time, grow and maintain its wealth, or fight inflation, I should say, and provide cash flow along the way. Otherwise, you may end up in a period of time where the flips are hard to come by and you've spent all the cash or most of it and you wonder what you did the last 10 years.
Sure. Yeah, that makes a ton of sense. Let's talk about that side a little bit more because I know a lot of people listening have rental portfolios of various sizes. And also, if they don't, I can tell you it's the most common thing we hear for like why people are doing this, right? I think Robert Kiyosaki definitely
Oh, yeah.
impacted more than a handful of people in this industry, right? And everybody's looking
Yep.
for that cash flow quadrant, right? And that's what you get with rentals, right? It's just a great business for that. I'm honestly jealous. Like, I'm not a real estate investor myself. I'm a marketer, right? That's what this
Yep.
whole business is. And can I invest the money that I get from this into real estate? Absolutely. And I do, but you can't do it like you can when you're a real estate investor, right? And you're out there seeing deals all the time. You understand the market and how it works, and it's more tax efficient for you, right? So you have
Right.
obviously it's like, I think like a wholesale or flipping company paired with that rental portfolio is just one of the best like wealth building strategies out there. So let's talk about your portfolio. Like, how long have you been building it? What does it look like now? What are some things you've been learning?
Started out with just single family rental portfolio, picking up we'll buy condos, townhomes, single family. We've got some small multifamily. I never got into apartment, so we don't have 1,000 doors of apartment complexes. While, that sounds great, I coach some particular people that were in that type of build when interest rates were lower, and that's really hindered the ability to grow that asset class. Doesn't mean deals aren't still out there, but single family is primarily what we built on. And then we diversified into oil and gas, diversified, put money away into stocks, mutual funds, into syndication deals. Some of those are LP syndication deals, some of them are GP syndicated deals, self storage, multifamily in the syndication capacity, not my own GP stake. And then commercial, industrial, office, and we've started to reposition some assets as well, which we talked about earlier, and we can kind of get into that deeper. So now I'm still building it. Obviously will always be building it, but it's more so right now I'm in the period of, or in the chapter, I should say, of optimizing, repositioning, looking at cash flow, looking at return on equity, return on initial investment, return on today's value, all of these return profiles, and comparing it to noise level and what I could get for less noise or more noise. And are they all in the right place? Are the chips where I want the chips to be right now? Or have some of those chips played out their role and done their thing, and now it's time to roll those chips into a bigger play?
Yeah, that totally makes sense. I like to joke that let's just say you're in a meeting with your leadership team. There's always somebody there that you don't see, right? There's the invisible seat
Always.
that's like the person sitting in that is basically like the person who argues for the status quo, right? And you could have four people there who are always trying to like change things up, but the status quo always has a larger and a stronger voice than almost anybody else can because it's the path of least resistance. So I like what you're saying about how you're rethinking some of that stuff. Just I've done the same with people in my company recently. You have to do that sometimes. Sometimes like the way your team shakes out over time just kind of happens naturally. And then you have to look at it and say, do we have all the right people and are they in all the right seats? And
Yeah.
sometimes it's a different answer today than it was a year ago with the same people in the same seats because the company changes. But anyways, that analogy to the side, what sparked your interest in this repositioning that you're doing?
It was a mentor and just showing up a couple times to a few different events and just having this thought process banged into my head of, are you in these assets for the right reasons? And are you really making what you think you're making? And this guy's big line that he may have gotten for somebody else, maybe not, is whenever I would say something, we used to do one-on-one coaching, and he would say, is that your truth or the truth? And usually it was just my truth. It was my truth that I was making the truth. And he's just been very good at leading me in the right direction. And one of those directions was, hey, you got these assets, you built it. Great, awesome. You check this box, you got the portfolio building, it's cash flowing, they're building equity, they're appreciating. But what are they doing? Are they doing as well now as they were then? And what could you do if you moved some of those chess pieces around and compare that return to the return you're currently getting now? Because I was looking at these triple net lease deals and with credit tenants. Everybody uses the Starbucks example on the hard corner at a 6% cap rate. You're a real estate investor, right? If you're not 75 years old with a bunch of money you're just trying to put to work, you're going to say no usually to a 6 cap. And I'm not saying I would say yes to a 6 cap right now, but what I realized when I really got into my returns is that I had the standard calculations. I was a month for vacancy, a month for repairs, true property taxes, true insurance. If you want to bake in property management, you can. You're looking at a 50% expense load or expense ratio on that market rent. And then you look at what the property has appreciated to. So now you're comparing your true net cash flow to, and I'm sorry, I was going a different direction with that. I was using a month of vacancy, a month of maintenance. But the problem is it's not a month of maintenance. Sometimes it's not a month of vacancy. So I went back to my bookkeeper and I pulled all the expenses over a certain amount of properties over the last 24 months and annualized that amount. Only one of those properties was actually 1 month's worth of rent for the year. All of the other ones were 2-3x plus. Throw those real numbers in, and that's just because it's not as cheap as it used to be to manage single family rental property. And you've got a little bit more turnover maybe now than you did in the past. And so you go look at that return and then you say, okay, what's the property appreciated to? What's my current equity? I've been paying down principal on my refi for 6 years, right? So I got principal pay down and then it's been appreciating. So we've got this. So what's the arbitrage? All right, my equity was 70, now it's 170. Say, okay, if I pulled all that 170 out, don't take taxes into account, right? Let's just keep it easy. You say you 1031 or whatever, and you just take that 170 out and you went and put it in something really quiet, right? Like money market account, quiet, no risk. What is that return? And how far off is that from the true return that money's actually making you right now? And what I found is that with these great rental properties that my initial calculator was showing I was making, the cash on cash return was all double digits plus. It looked great, but it wasn't about that. It was about the return on the equity, the current equity in the property. And it was all like my average was close to 4.5% return on equity. So I've been saying no to the 7 cap, no to the 8 cap, but I've all the while been saying yes to the 4.5 cap and not even knowing it.
Yeah, that's a super wild thought. Because a lot of people are just calculating it based on the cash they put into the asset. But you have to consider if you got that 170 grand in equity that you're choosing to keep in there, that's the same thing as basically deciding to buy that property today and put 170 grand into it.
100%. That's exactly it. Nailed it.
And that's wild.
So would I buy that property today for that return? Down the list, ask myself, same question. No, definitely not. No. Maybe. Circle that one. No. So that's the exercise. And so from there, we started analyzing commercial properties, absolute triple net lease deals, and kind of learning that asset class. What do you want? What do you not want? What areas? What industries? What credit tenant? Do you have to have a credit tenant? What lease terms? It's all, a lot of that world is baked into the lease that you're getting. A lot of the value is in there. You got to look at the building too, but a lot of it's in the lease and the tenant, and just learning that. And so we've been identifying those, and when we find a good one, we will purchase it, which the one that we closed on like a month and a half ago, I'd say now, we bought it, did a reverse 1031 exchange, and then are selling a property to recoup the cash to close that was needed. I got a loan on it for 70%, raised private money for the gap, And then we're paying off our private money lender gap funds based on the reverse 1031 exchange. I also didn't even know a reverse 1031 exchange existed until about 6-7 months ago when I started this exercise. I didn't even know you could do that, which is really cool. I love it because I don't want to be pressured to go find the right asset. I think a lot of people sell properties and then they're forced into fitting in that timeline and buying a property that it might have been better off for them to just pay the taxes than to buy the property that they bought. But they were so looped into, I can't pay taxes. I can't pay taxes. They bought something that wasn't the best deal. I'm not saying that is always what happens, but I didn't want to be pressured into that. So you spend a little bit more and you get to flip it on its back and do the reverse. And I find that it's a little bit more complicated. It's called a complex exchange for a reason. That's why you pay good people to do what they know how to do in their individual space.
So Parker, for all the people here, definitely not me, the other people that don't know exactly what a reverse 1031 exchange is, could you help me understand? Because I'm trying to picture, like, I know what 1031 is. I'm trying to reverse it in my mind, and it's not super clear what this means.
So there's more to it, but essentially the easiest way to think about it is a traditional 1031 exchange. Let's just talk about that for a second. You are selling a property and then you have
Mhm.
6 months to buy a new one. So there's some rules that you have to abide by, right? 200% rule or 3 property rule. There's another one that isn't commonly used, but let's just say you sell a property and then you get 6 months to buy a new one to roll those assets into it. Now we're just doing the exact opposite. I'm buying the property that I want to replace whatever I'm selling with, and then I get 6 months to sell those properties. So it's
Oh,
pretty
so then
difficult
you get the
to
right deal because you don't have to decide to sell the property until you know you've already found the replacement. So you're not
exactly.
like 5 months in making a bad decision.
Exactly. And how easy is it to identify up to 3 whatever rule you're following, properties you're going to sell that you already own? You already know what
So
you're going to
easy.
sell.
Yeah, that's so interesting. Okay, so that was a slight sidetrack, but that's news to me. So it's interesting to hear how that works. But basically, what I'm gathering from you, and I'm reading a little bit between the lines here, because you mentioned you've invested in all these different things. You mentioned a bunch of different kind of asset classes, triple net leases being one of them, even stuff like self storage, industrial, commercial, like all that. But it sounds like your portfolio is or was mostly single family. And as you looked at that, you realized you're only making about this 4.5% return on that. Am I reading between the lines properly and basically saying that you had mostly single family? And then when you started to really calculate the return on equity, you realized it wasn't returning quite the way that you thought. And then now all these other assets started to look more attractive. Or previously you would have said no, you would have said, why would I make 7% of my investment there? But now you're actually taking funds from the stuff that was making 4.5 and putting it into that.
Exactly. Yeah. I've had a smaller piece of some partnership commercial triple net lease property also for a while, about the same time I started building my single family portfolio. That was before I started like intimately getting involved in active real estate investing myself. So I've watched from the sidelines, so to speak. And as a, let's call it just a, I'm a GP, but let's call it more of an LP position, and seeing how it works and what some of the pitfalls are, and how quiet the money can be when done correctly. And so when the time came where this was getting just really banged into my head because it had to be given to me from a different person than the person or people that I was doing these other deals with, for me to actually hear it correctly. Funny how that works. It's very dependent on who tells you the thing for how you hear the thing and process the thing. But anyway, that happened. Timing was right. And I was like, I need to start repositioning some of these single family assets and start doing some of this stuff for myself. And it's really cool because I've built a calculator or spreadsheet where I'm saying, all right, I'm taking literally this income that has, or these properties with this equity, with this net cash flow. And if I sell them, reverse 1031 and go into this property with this debt amount, these expenses, actually there's no expenses because it's true triple net, which is another great thing with that. There's no landlord responsibility. Obviously, you have to make sure your lease is legit, but the ones that I am after are absolute triple net, no landlord responsibility, no property taxes, insurance, not even the pavement on the asphalt parking lot, the roof, nothing. It's all the landlord. One I'm under contract to close next month is it's an owner sale leaseback. So he owns and operates the business and owns the building as well, has for a while, and now is selling the building. And then he's selling the building to me and then signing a 10-year lease with 2 5-year extensions to lease it back to me. So we're doing a sale lease back on that one, and I'm 1031ing and selling 3 of my rental properties to recoup the funds that we are raising for the gap on that one.
All right, very cool. That's awesome. And how long have you been doing that for? Well, how long ago did you get that advice?
About 7 months ago, I guess I started getting that advice about a year and a half ago. And it took a second event. I heard it again. And it's always just been a part of his pitch, like a reminder, not a pitch, but just part of his presentation. Oh, by the way, here's my spreadsheet. Here's how I'm looking. He bought about 100 or so rentals in Alabama. And that was about 5 years ago, and has been tranching them off and going into triple net lease commercial property. So following in his footsteps at a smaller scale. And it's been really cool to see the benefits. And I'm doubling plus my net income on the equity. So it's cool. I'm looking at the spreadsheet and it's telling me, hey, you get to sell these properties, replace it with this one, 2.2x your net income off this property. And at the same time, I own these 3 particular properties free and clear that I'm selling. And now I'm going to have about $850 a month, I think, of principal pay down on this new loan. So I know it's not cash flow, but that's a factor, right? This one property is 1.85 million is the purchase price. I'm going to bonus depreciate 100% cost seg that thing. That's going to be a massive impact on my taxable gain for the year. And there's the scale at which the benefits are for deals like this are so much higher than the little single family one-off pops.
Yeah, that makes sense. Help break it down for me as simple as you can. Like now that you've spent so much time looking at these numbers, you looked at different classes of assets and all this kind of stuff. What numbers do you need to see now for it to look like this is an asset that pencils out as a good enough return on investment? IRR, what I don't know how you're calculating it. Like I'm
Yeah.
assuming with that principal pay down, you're counting in the equity you're building and that type of thing.
I'm not factoring in the principal pay down to these numbers, but I'm looking at that as like a caveat. If there needs to be a kicker to make the deal win, it's okay. I'm also getting this, but I'm trying to not count on that. Just like we don't try and count on appreciation, but that is real money that's being made every month as far as the principal
Mhm.
pay. Something you can count on a lot more than appreciation. But the cap rate is going to be based on your available cash that you have to put to work, the timeline that you have to be able to put it to work, and then probably the rest of your portfolio. It's almost like a risk mitigation thing. Obviously, everybody knows lower the cap, unless you're just buying stupid deals. Lower cap means less risk, especially in the triple net lease world. Higher cap means more risk. Higher cap might mean more tenants, not credit tenants, short-term leases, vacancy, value add requirements to make the property perform, and then all the way down to your 5.5 cap Starbucks on a hard corner with a 25-year corporate guaranteed lease. You have
Yeah.
zero fear in that deal. That restaurant could just sit completely vacant, and you can continue to collect cash flow just like it would be operating. So that to answer your question, I hate to give it, but it depends on your
Mhm.
situation. And if I needed to get something placed quickly, I'd be fine with a lower cap. Maybe something I'm probably not going to go 5.5 because I don't have that much money that I want to go place or that I can go just place in a long-term asset like that. I would love to have those, I would call them legacy assets, or be in the position to buy those, take down those hard corner credit tenant, 20-year plus corporate guaranteed triple net lease type tenant in the future. But right now I'm focusing more on let's call it my lowest one is an 8.2 cap, and the one I bought before that was a 10 cap. So then that's the range. You get up into the 12s. I have another one that we're stabilizing right now that might be around a 13, but many more tenants, more moving parts, management headaches that need to be dealt with. Debt was harder to get. And so there's just a lot of different factors there.
All right. Very cool. Thank you for sharing all this. today. For anybody
Yeah.
listening that wants to get a hold of you, is curious about any of your companies, what's the best way?
I would say it depends on how we want to connect on the coaching realm, coachingwithparker.com. I didn't really talk about it much, but we do have a hard money lending business. We fund deals, transactional funding, gap funding, new construction deals. I'll be the first to say we're not the cheapest on the block. We're not Kiavi. We're not Anchor. We're not institutional debt. But if you want the fastest 72-hour funding, easiest lending company to work with that is small mom and pop shop style that is built by investors for investors. I've been investing in deals for 10 years. I know exactly what you guys want when it comes to funding. Fasttrackfunding.com is where you need to be.
Right on. All right. Thank you, Parker. And for everybody else listening, I will see you next week.
See you, Brandon.